Forward Guidance is brought to you by VanEck, a global leader in asset management since 1955. You'll be hearing more about VanEck ETFs later on, but for now, let's get into today's interview. I am joined by Nick Givanovic, veteran bond trader with a storied career at Salomon Brothers, hedge funds, and JP Morgan. Nick, great to see you. I want to start by asking you, what is your view on asset markets right now? How are you thinking about the markets? And in particular, which do you favor, stocks or bonds, and why?
I'm a much better buyer of equities than I am of bonds, until I see some data that says that I should be otherwise. And I know that, a lot of people are anticipating that data, but I just keep on not seeing it. My methodology is one of reacting to data, not trying to anticipate it. And therefore, if I can't, I won't try to anticipate a turn in equities, because it can always go for much longer or much further than anyone thinks possible. And that's exactly what we're getting. We're getting, much more money moving into equities than bonds. And I think there is a continuation, or there should be a continuation, of people moving money out of bonds and into equities. The problem is that we know what the supply of bonds is going to be, of treasuries is going to be over the course of the next 3-4 months. And we know that the likelihood is that in 5-6 months' time, they're going to have to up it, not reduce it. I mean, I can't see that these elections in the US, whatever they bring, I can't see they're going to bring any kind of a executive that wishes to reduce at all the budget deficit, whether it's Trump or Biden. There's only so long that the Treasury Secretary, whoever that person is, can manipulate the percentage of bills against bonds that are issued. It can go on for a while, but it can't go on forever, because then you're actually putting the whole of the deficit structure of the country in jeopardy. And I don't think that anyone is going to be that political to do that. Now, at some stage, if it's not this year, it's going to be next year for sure, that they're going to have to start rebalancing away from bills and into coupons. When that happens, I just can't see term Premia staying negative. I just can't. They're at zero now, so you get no benefit whatsoever from owning 10 years, 30 years, and you have all the potential downside of that rebalancing between bills and coupons when it comes. Why would bond prices rally? What would make interest rates go down in the States? Well, one is obvious, and that is a recession, or a weakening of, not just a weakening, but a substantial weakening of growth projections going forward. Risk off swamps everything. Always has, always will. So you can fund whatever deficit you like if it's risk off. What you can't do forever is fund a growing deficit with this imbalance between coupons and bills if you don't have a growth slowdown. If GDP keeps on growing at 3%, that kind of range, say 2 to 3%, bond prices just can't do much better. And then it becomes a question of, are equities going to go up through the multiplier or through earnings? Well, at the moment, they're going up through earnings growth. I know that we've built in a lot of expectations that earnings growth is going to be a lot, 12, 13% for 24 and 25. But I feel much more comfortable investing in in equities than I do in bonds, because I think the downside in equities is lower than the potential downside in bonds. I've seen bonds go 1% in, which would be like 20% at these yields in a month without any problem at all.
You mean 100 basis points of move in yield, so a 20% move in the price?
Correct. That can happen at any stage when there is an auction failure. And I'm not predicting an auction failure, far from it. What I'm saying is that at some stage, if you keep on putting one straw after another on the camel's back, you don't know which straw is going to break the camel's back. You keep on doing it. One day when you're least expecting it, it happens. And then the market reacts very badly indeed. So given the combination of the current data that we have, and that is decent growth, I can't see any signs of moderation. Could we get some? Of course we could, but we haven't had any yet. And until that yet happens, I will prefer to invest in equities than bonds.
So you're explaining why you prefer stocks over bonds, and that's because just U.S. growth remains robust, resilient, whatever word you want to call it, and the U.S. government is borrowing a lot of money, bills, bonds, however long.
Not only is it borrowing a lot, it has no plans to reduce it, no credible plans to reduce it. And the third factor I think is very important. The mix between bills and coupons can be at this level for a while, but it can't be at this level forever. So all the surprises that you're likely to get on that front are negative surprises as opposed to positive surprises.
Bills versus coupons, that's how long it takes for the government to pay you back. And so a bill, it expires in 1 year, let's say, and if interest rates are at 5%, you'll buy it for $95 and then you'll just get $100 at the end. Whereas a coupon, like a 10-year note, you'll buy it at $100 and it'll pay you 5% every year as a coupon. That's why it's called a coupon. So this notion that the U.S. Treasury has issued a lot more bills than coupons than was expected, and that has basically supported liquidity conditions because it takes a lot more balance sheet capacity to own coupons, which are closer to a risk asset than a 1-month bill, which is basically cash.
Correct.
Pretty much is cash. As someone who was a bond trader at JP Morgan, the biggest bank in the world, but
Salomon mostly, yeah,
and Salomon Brothers, isn't bank appetite for bonds often very large? Such as, for example, in the case of 2020, when it was a horrible time to buy bonds. In April 2020, interest rates the 10-year was at 1%. Mathematically, it was a very bad time to buy bonds, but banks were just doing it hand over fist. It's a much better time to buy bonds now than the past. I mean, I know, 3 years ago was horrible, but
no. In fact, the opposite. Banks are leverage buyers.
Mm-hmm.
So what they do, they fund short and they buy long, right? So when you have a positive yield curve, as we did when short-term Fed funds were at 0 and say 30 years were at 1.25 or something like that, or 10 years were at 1 or just below, it actually paid them to leverage up their balance sheet with US Treasuries. Now it's the opposite situation. And that is yet another reason, which I should have mentioned earlier, but I didn't, is that I can't see who is the buyer of treasuries here. We have all the traditional buyers of treasuries like central banks, and at the moment we don't have much support from foreign sources like Japan, which has been traditionally a very big buyer of treasuries, simply because swapped back into yen, it actually pays them to buy JGBs as opposed to US Treasuries.
Japanese government bonds, yeah.
Yeah. The biggest buyer traditionally of US Treasuries you're correct, has always been leverage players, whether those be hedge funds or whether they be banks using the balance sheet to leverage their purchases. during a period of a negative curve like we have at the moment, that just isn't so. They are funding day to day at 535 or whatever it happens to be, and then they're buying 10-year notes at 465 or whatever it is today. That loses your money day after day after day. The only way that is going to make you money is when the 10-year note, if the 10-year note appreciates, and then you can sell it. But that's really, you're in a range. So what you're looking to do if you're a bank trader is to buy them cheap and then flip them out again, right? So you're looking to trade the range. You're looking to buy the low end of the range and sell at the high end of the range, and you're hoping that some economic figure comes out weak and you can sell the bonds that you bought. But that is not something which is sustainable in itself. When you have a positive yield curve, you can just carry your book because you get funded each and every day at a positive rate. You understand the difference, yeah?
Mm-hmm. Yes.
So it's unlikely that the banks or the hedge funds are going to be big leverage buyers and holders. They might be big leverage buyers at levels, but they'll be looking to sell them as well. So they won't be holders until they get positive carry.
So in 2020, the short-term rate was 10 basis points, basically zero. And the 10-year was at, let's say, 120 basis points. So it was a positive carry position. It didn't end well if you held that position because borrowing costs rose and the price of the bond collapsed, if that's too dramatic of a word.
I have some sympathy for the explanation. If you remember at the time of SVB, what the explanation was. And the explanation was that the Fed told you, the Fed predicted that interest rates will never go up more than 0.5%, and okay, so that is why the banks entered that position. The smart banks like JP Morgan, with Jamie Dimon, it said, okay, this is a lot of duration that we are carrying. Let's hedge that duration because short-term interest rates would go up a lot more than the Fed predicted. And he was proved right. The people who didn't hedge were proved wrong, and of course they got carried out. But that is the game you're playing. That's the market that you have to trade against. What can I tell you? Duration to me is expensive still. It was expensive then, is expensive now relative to the short end. And given that I can't see what is going to make it appreciate much more from these levels, given the term premia is still negative or zero. I mean, we can argue whether it's -5 or zero, but it's very, very low given historical pricing. Why would you invest in 10-year treasuries? It just one of the most unattractive periods in history that I can remember, and I've been doing this since, let's call it 1983 or 1984. I just can't see that the situation is going to get better. For the situation to improve, you need to have the political will to reduce the deficit. You're going to have to already be in a balanced position with your issuance of bills against coupons, which you are not. And you also need to have leverage players who have the balance sheet to carry the positions positively. And none of these circumstances are present at the moment. So what is the best you can say? The best you can say is that bonds are in a range until and unless you get a weakening economy and the Fed can really start cutting rates. But you need to have also the combination of inflation coming down towards their target, or at the very least, the Fed having the confidence that inflation is heading down to target. Well, Powell has just told you several times, including today at this conference in Amsterdam, that his confidence is not that high. or that he needs far more additional data for the level of confidence that he has to improve. So unless you get very low CPI or very low employment data or very low retail sales, which are all unlikely to happen in the very short term, the risk reward of owning bonds here is not that great, or duration in general.
We record this the late morning of Tuesday, May 14th, and Jay Powell at the Foreign Bankers Association in Amsterdam, what you're referring to, his exact quote was, "The first quarter in the US was notable for its lack of further progress on inflation. What that has told us is that we'll need to be patient and let restrictive policy do its work, aka interest rates will be higher for longer." So, Nick, I want to ask you about, you're saying as a trader, as a bond trader who has to fund themselves in the market at the risk-free market, if you borrow at 5.3% overnight, which is where the overnight Fed funds rate is, to buy a 4.5% yielding 10-year, you're losing 80 basis. You're not losing 80, but annualized, you're losing 80 basis points of carry on an annualized basis. So that's unattractive. But what about, and I believe Salomon Brothers, where you worked, that was the case, that they funded themselves in the markets, i.e. they did not have depositors. What about depository institutions that, if a giant company has a bank account, they don't pay interest. They don't get any interest. So banks, what they pay on deposits is lower than 5.3%. For some banks that are screwed, it actually is 5.3%, and some actually are paying more on CDs, which is not a great sign. But let's say Bank of America's overall cost of funds is 3%. It's lower than 5.3%. Wouldn't it be attractive to park it in a 4.5 yielding Treasury? No.
Sure. I mean, of course it would be. But how many of those institutions are there? Mm-hmm. And how much are they willing to put into the market, at these levels? We are getting over 500 billion of issuance each and every quarter, and this is new money, right? New money. So if you take what is being issued, which is over $1 trillion, and what is maturing, the net is about half a trillion per quarter, right? So you need to have constant new supply of demand, if that makes any sense. You need to have more and more demand to meet the funding needs of the Treasury. How long can that go on? I mean, Bank of America, JP Morgan, Citibank, and the likes are, at some stage going to run out of room on their balance sheet if they haven't already. I don't see that JP Morgan is very bullish on bonds either. I mean, I read all the research that everyone puts out. There's a very good point that people miss, and that is that no one has the balance sheet to pre-position for this huge supply. That balance sheet just does not exist out there. So yes, a lot of institutions can pre-position the individual auctions when they come, but you've seen how the bond market trades. The bond market basically reacts to data and then remains still waiting for the supply. Then the supply comes in, the auctions, and it just sort of, everyone's relieved all of a sudden that, yes, the auction went fine. There was no disaster. And then the next day, the auction is underwater, which basically means that everybody who bought it lost money, unless they were very, very quick and just got out. The point I'm trying to make, the larger point, is that most of the buyers of those auctions, i.e. the central banks, are price insensitive, and they really don't care whether they are down 5 basis points or up 5 basis points, at the end of the day after the auction.
So sorry, Nick, wait, who's insensitive? The banks or central banks or both?
The central banks. Okay. The central banks. And even to a certain degree, the people who are finding themselves at 3% and investing at 4.5%, for their balance sheet needs. Don't forget that most of the stuff that the banks do is not for their balance sheet needs. Most of the trading is done on a purely, am I making money or am I losing money? These are traders with their own individual limits trying to make a living.
Market making, buy for 53, sell for 53 and 2 cents.
Correct. I mean, if you make a plus, you're happy. A plus being, half a tick. That is what the banks do. When will we get signs that the banks, or not the banks, but that the market in general is becoming more price sensitive? And that is when the dealers will be left with more of the auction that has been the case up to now. And you can see that in the percentage of non-comps and data like that. You can see how much the dealers are left with to get rid of.
Sorry, what's a non-comp?
Non-competitive bids.
Oh, okay.
That data is readily available and has been roughly steady. So after each auction that we get, the dealers are not left with very much, and they've pre-positioned that auction, i.e., they've sold the WI, they've done, they've done butterflies with the immediate bonds either side of the duration being precise duration being issued. So they hedge themselves in every which way, and they're left with very little of the auction that they might need to get rid of. Now, if that started rising substantially at some stage, that will be a sign that things are not well in the bond market. The dealers are struggling to balance their books, and because they're just not seeing enough demand for the supply that's being sold by the Treasury. But that is not happening at the moment, and that is why the market has basically been in a range. It has been a wide range, but it's still in a range.
Can you walk us through what are you seeing at the recently in bond auctions? What are you observing, and can you explain more about non-competitive bids?
Well, I mean, there's only two types of bidding you can do. One is a non-comp, which is a non-competitive, i.e., you get your the bonds at the average price, or you can put in a yield level that it's the same as a limit order.
Okay, got it.
You only want to buy them at that price. And then the question is, does the Dutch auction touch your price or not? And it's as simple as that. Most, let's call them retail buyers, put in non-competitive bids, i.e. they'll just buy whatever the average price of the auction is. And central banks tend to do that. They put in their bids for the average price. The dealers are much more price sensitive, and therefore they will gauge the call during the course of the day before they submit their bids to the Treasury. They will see where the WI is, trade the WI very actively, and then put in their competitive bids, and only get filled if the WI, that price is touched in the Dutch auction.
Sorry, what's the WI?
When issued.
When issued, okay.
The when issued bond, yeah. Because every bond that's being auctioned that trades as a WI before the auction and as an actual bond after the auction.
I thought it was the case that only primary dealers, which is a list of banks, JP Morgan, Goldman, Citi, which is what used to be Salomon Brothers, so they merged, where you used to work, were the primary dealers. I thought that the Federal Reserve, when people say they monetize the debt, the Fed does not buy from the Treasury, was my understanding, at an auction. They buy from JP Morgan, who buys from the Treasury. So there's an intermediary, right? Or do they? I don't know.
I can't say that I'm 100% sure, but I'm pretty sure that they buy them direct from the Treasury at the average price. Because what would it be? What would they be in it for? JP Morgan, they're just, what are they, just putting in the bid for the Fed? No, I don't think it works that way. But I'm not 100% sure. Please check it out. I think they buy direct from the Treasury at the average price, but that's an add-on, right? So it's a complete add-on. So say the auction is 25 billion, and the Fed wants to buy 5 billion. That doesn't mean that the Treasury is issuing 20 billion to the public and 5 billion to the Fed. No, the Treasury is still issuing 25 billion to the public and issues an extra 5 billion to the Fed.
I'm just, realizing how much more I have to learn about the auction process. It is very interesting. So it's safe to say you were definitely not bullish on U.S. Treasury bonds, but you're not wildly bearish either.
Well, I'm not wildly bearish now. Am I short? I am. I'm not short a lot. I am looking for this yield curve to steepen at some stage. I'm not getting any satisfaction. I'll be frank about that. It's just not steepening. My positions are not making money at the moment. But I mean, today I shorted it. I got stopped out. I shorted it again. I just can't play it long at the moment. That's the problem. I'm looking for places to sell, unless the data that I receive, the factual data, says that I should be doing something different. And it hasn't been. That data has not been forthcoming for 4 months now, 5 months since the beginning of the year. So I'm going to continue being bearish on bonds until the data tells me that, it's over.
In 2017, Forward Guidance's exclusive sponsor, VanEck, was the first ETF issuer to file for a Bitcoin-linked ETF. 7 years later, Bitcoin ETFs are finally available. Using the VanEck Bitcoin Trust, ticker HODL, you can invest in Bitcoin with 0 fees until March 31st, 2025. That's right, 0 fees until March 31st, 2025. Search the ticker HODL in your brokerage app today or visit vaneck.com/HODLFG to learn more. Now, the disclosures. An investment in the VanEck Bitcoin Trust, also known as the Trust or HODL, involves significant risk and may not be suitable for all investors. You could lose your entire investment. The Trust offers fewer investor protections as it is not registered under the Investment Company Act of 1940 or as a commodity pool under the Commodity Exchange Act. For a complete discussion of the risk factors relative to the Trust, carefully read the prospectus linked below. You can learn more about HODL and its 0 fees until March 31st, 2025 at vaneck.com/HODLFG. That's vaneck.com/HODLFG. And now back to the interview. Right now, the yield curve is inverted. So, for example, the 10-year yield is lower than the 2-year yield. And you said you expect it to steepen, so you expect it to get less inverted and maybe even uninvert. Tell us about how you put on that trade, because it sounds like it could be a positive carry trade. You short the thing that yields lower and you buy the thing that yields higher, but the 2-year has a lot less duration. So if you want to be duration matched, you have to buy a lot more of the 2-year, and then you have to borrow money to do that, and then you're borrowing money at the overnight rate, which is higher than the 2-year rate. So is putting on a steepener, or various ways of putting on a steepener, are they positive carry, i.e. you're making money every day if nothing happens, or negative carry?
It's a wash at the moment. I mean, the carry doesn't kill you at the moment, but it's certainly not something that that is making you money at the moment. So, for example, let's have a look at 2s 10s.
Mm-hmm.
2s 10s have been in a range since the beginning of the year of, let's say, 16 basis points to 40 basis points. And at the moment, they're at 36 basis points, just about exactly where they started the year. It hasn't made anyone a fortune being looking for the curve to steepen. It hasn't made me a fortune. But I still think that at some stage, either the current buyers of long duration are going to get fed up with the negative carry, because the inflation data and the growth data basically are both sticky, i.e. nothing happens to makes you think that any kind of slowing in the economy is imminent. Inflation stays sticky or volatile. Volatile inflation, i.e. like we had the revisions to PPI today, which were far lower, but we had hot numbers for this month, for the month of April. So that's a volatility in inflation. If you think about it, if inflation is going up and down without a direction, that tends and has always tended to increase term premia, simply because more volatility gives you less certainty. Less certainty makes term premia expand. So my basic view is that either term premia are going to rise, and therefore the 10-year note yield is going to rise, while the 2-year note stays very much fixed. Because let's face it, Powell has been very clear in his presses that he believes that current monetary policy is restrictive. We can argue until the cows come home whether it is restrictive or it isn't restrictive, but he thinks it's restrictive, and that's all that matters, really. So the bar to further hikes is very, very high indeed. I think anybody reasonable will agree about that. He has said it many times, and he repeated it today when he was asked whether current monetary policy was restrictive enough to bring down inflation to 2%. He basically was as clear could be. So the bar to further hikes is very high indeed. What does that mean? That means that it's very unlikely that the 2-year note will trade anywhere near Fed funds for the foreseeable future, because they will always build in a bias for easing, i.e. the probabilities of the Fed easing over the course of the next 2 years will always outweigh the probabilities of the Fed staying still. If you thought the Fed was going to stay still for 2 years, and that was the market view, the 2-year would trade maybe just north of 435 just to have a little bit of positive carry, but it wouldn't trade much higher than that. So I think the top for the 2-year is around 410 for the time being. I apologize. If I said 4.1, I meant 5.1. I can't see it going higher than 5.1. I just can't see it trading much higher than that. And at the moment, we are at 484. So we have 25 basis points of that it could rise. On the other hand, this constant, how shall I put it, drip, drip Chinese water torture at the long end of rising term premia, more issuance, less room on balance sheets, etc., political risk of neither party even talking about correcting the unsustainable path of the budget deficit. Those are all things which over time are going to make long duration less and less and less appealing. And therefore, if we have a ceiling to the 2-year, which is 20-25 basis points away from here, we don't have that ceiling for duration. We have no ceiling for duration. Duration is going to be bid, just like we have no theoretical floor for duration. We don't have a theoretical ceiling for duration either. And therefore, I think the yield curve is going to steepen one way or the other, whether it's by the 2-year note going up towards 510 and then the rest of the curve slowly catching up towards 510, or the other way around, which would be a bull steepening, which would be an economy which all of a sudden starts substantially weakening, also inflation going down towards 2% target, and then the Fed can do what it says it's going to do in its dot plots, and that is cut rates about 5 times in all between 2024 and 2025, bring short rates down to let's call it 4%, 375, 4%. Then the 2-year note can trade on the 410, and the 10-year can actually stay where it is or come down very little. It's now 4.5, 448. It can come down to 430 and then start going up. But in any case, the yield curve would steepen all in all. 2-year notes would appreciate much more than the longer duration. A positive yield curve is the natural state of things. So I think at some stage that has to happen. Whether it takes another 3 months or whether it takes another 6 months, I think in that kind of time frame, it almost has to happen.
Very interesting. So I think of the bond market as kind of a boat. And if you're saying the pressure for interest rate cuts is on the left side of the boat, and if everyone's worried about a recession and growth is going to slow down, that's a lot of pressure on forward expectations of the market, the Fed to cut rates. So the 2-year would be low. Now, there's not that much recession worry relative to a year ago or even 6 months ago. But what you're saying is that even though the pressure on the left side of the boat isn't that high, the pressure on the right side of the boat is extremely light because Jay Powell pretty much said very unlikely that we're going to hike rates. So there's much less pressure on the left side of the boat, i.e. cuts, but there's extremely lack amount of pressure on the right side of the boat for hikes. So all in all, the 2-year is being pulled to the left side, i.e. interest rates down.
Don't forget about a thing which is called reinvestment risk. You have a whole load of people who are in bills because they're either money market funds or let's say that retail saw that 525, 535 in bills is very attractive and they're staying in bills. But at the first sign of the economy weakening, you're going to have a massive move in the short duration because of the anticipation of the reinvestment that those people need to do. Because you might be getting 535 for 3 months, but then the Fed cuts 50 basis points. Where's your next reinvestment? So you will get a whole load of people switching from the very, very short end into 2-year, 3-year, and so on. And that can happen very, very quickly. I've seen it happen in a matter of 2 or 3 weeks. You can have a massive move in the 2 and 3-year notes, while far less in the 10-year, far, far less. I mean, the 10-year could even, because of all the curve trades which will be put on, the 10-year could even go the other way. So it can be, when it happens, these inversions are normally a sign of recession, or traditionally they have to be, or let's say a weakening of the economy, or to put it precisely, a change in the probabilities that the market assigned to growth. So all of a sudden you go from a 60-70% probability of 3% growth to a 60-70 probability of 0 growth, or 0.5. But the difference between 0, 0.5 and negative is not that huge. And then people naturally extrapolate and they go overboard the other way. So when those odds change, and the stock market will tell us when those odds are changing, they're not at the moment, right? The stock market is as stable can be at very high levels. Then that will happen, and you will see that disinversion of the yield curve. It's not happening yet. I don't foresee that it's going to happen in the absolute foreseeable future, but at some stage during the course of this year, I think it just has to happen one way or another, via bull steepening or a bear steepening. But one way or another, the forces that I've described to you are working in the background. At some stage, it just has to happen.
So bull steepening is when short-term interest rates fall by more than long-term interest rates, and bear steepening is when long-term interest rates go up by more than short-term interest rates. Do you have a view on if and when there is a steepening, the likelihood of that it is a bull steepening versus a bear steepening?
All I know is that bull steepenings are much faster when they happen. Why? Because of the massive reinvestment risk. If you think about how many trillions of dollars are in money market funds, and B, the buyers, when they come in for the 2-year and the 3-year note, are not that yield sensitive. 2, 3, 4, 5 basis points to them means nothing. So when they come in, it's just an avalanche, and yields can fall very, very quickly. So while I can't answer your question, I can give you my probabilities. I think it's far more likely to be a bull steepening than a bear steepening if what Powell is saying and what the Fed is saying is correct. And that is that current monetary policy is restrictive. Because if current monetary policy is restrictive, at some stage, that lag between the monetary policy being implemented and it working, it has to stop, right? At some stage, either monetary policy is not restrictive enough or the lag ends. Now, whether the lag takes 18 months, 2 years, 3 years, I have no idea and I can't tell you. But at some stage, this, and we are going to get the signal from the stock market. And again, we are not getting it at the moment. My bet would be that the odds are in favor of a bull steepening rather than a bear steepening. A bear steepening would actually mean that Powell and the Fed and all those PhDs are not correct, that policy is not restrictive enough. And then that coupled with everything that I've been saying so far about the supply of bonds, coupled with the fact that nobody can possibly, if monetary policy is not restrictive, why would you buy bonds as opposed to equities? No reason whatsoever, right?
If you hate money?
Then that is precisely what is likely to happen. You're going to have a massive move of real money into the equity market and out of the bond market. And then you get this bear steepening, especially, coupled with the fact that it's an election year and Powell has told you that, he doesn't want to hike. And you have monetary policy, which is not tight, opposite of what he's saying, then you get a spike in equity prices. Mm-hmm. So being long of equities and short of long duration and long of short duration, to me, is the best of all worlds, because one of these is going to work, right? It's going to be one way or another. And I can't see an alternative to this scenario.
And so you say you can't see an alternative to a bull steepener or a bear steepener, but it's not impossible that in a year from now, the yield curve is still inverted. What would that scenario be like?
I am really struggling to think of it. It's all a question of degree. So if we have a look at where the yield curve, the 2s10s topped out at just over 1% inversion. And now they're at 36 basis points of inversion. So what would it take for us to go back up to 1% of inversion? I don't know. It would have to be tightening by the Federal Reserve. The only thing that would make bonds, long duration bonds, happy is for Powell to wake up one morning and say, sorry, boys, everything I've been telling you for a year is absolute bollocks. Mm-hmm. Policy has not been restrictive at all. In fact, it's loose, and I'm hiking rates to 7.5%. Yes, that would make the yield curve much more negative than it is at the moment. But then you have to start thinking, well, what are the odds of that happening? I think the odds are very, very low indeed.
What about the other possibility of, in a year, short-term, the Fed funds rate is also 5.3% or 5.25% to 5.5% range, but the 10-year is 100 basis points lower just because people are rightly or wrongly pricing in a recession, or, the people who buy bonds, they just found a bunch of money. Or they print, they
Where did they find this bunch of money? They found $2 trillion under the bed, which was going to be the total issuance.
Yeah.
I think that, as I always say, anything is possible, but everything has a probability attached to it. I think that scenario has an extremely low probability attached to it for all the reasons that I've mentioned. The issuance is huge. Nobody's got the balance sheet to buy, to buy all this. Why would anybody, if inflation stays where it is and also growth stays where it is, why would anybody all of a sudden be buying bonds at 2.5, a percentage point below here? I just don't see the reason for it. It's extremely low odds. That's all I'm saying. Now, can the yield curve just meander around here for another 6 months? Easy.
So you were very clear in what we just said, that you think the odds that the yield curve remains inverted for a prolonged period of time, i.e. longer than 6 months, is quite unlikely. You didn't directly answer, as it give probabilities about which is more likely, bull steepener or bear steepener, but it sounds like you maybe think bull steepener is a little bit more likely. Perhaps, is that fair to say?
Well, the bull steepener, as I said, would occur much faster.
Got it.
Now, what the odds are? Well, that's the same as asking me what are the odds of the stock market correcting 10, 20%. Because I can't see a risk-off move that doesn't take stocks down at least 10%. I mean, let's face it, the risk-off move would be happening because the market is discounted much lower growth. Therefore, the possibility, if not the probability, of a recession as opposed to zero growth, because the difference, as I said, between 0 and -1 is tiny. So if the market now starts discounting that we're going to go into recession, but for that, you have to have a continuation of data that supports that theory. We haven't even got one piece of data that will support that theory. We can have as many pieces of data which say that growth isn't going to be 3.5 to 4.5, but it's going to be 2.5 to 3.5. But we've got zero data that says that it's going to be below 2.5%. All sorts of data would manifest themselves, from retail sales falling sharply to unemployment claims, weekly unemployment claims rising sharply, to the non-farm payrolls rising sharply. All kinds of data would have to show the same path. And so far, I think you'll agree that none of them are showing that that is the path that we're following.
So, Nick, when you're comparing across your career the various bull steepening occurrences and the various bear steepening occurrence, does it make sense to you with, okay, we have all the sample size of the bear steepenings since the 1980s. Should you compare right now or a potential bear steepening to all instances in the past of bear steepenings since the 1980s, or all instances of bear steepening since the 1980s that occur when the Federal Reserve has already raised interest rates and has not, i.e. cut interest rates? Because I believe it is the case that most bear steepenings occur once the Federal Reserve has already cut interest rates, and then you're coming the beginning of a new cycle. So April 2020, interest rates are at 0. The long end marches up as short-term interest rates do nothing. Probably 2009 as well. I think that is kind of the more typical bear steepening. The bear steepening that we had of the fall of last year, where Powell didn't cut rates, but you still had that bear steepening. That I believe is the case. I've looked at it. I obviously was not there.
I mean, the market has changed a lot over the years. If you take something like the period from 85 to 86, when the Fed was cutting rates, I think I'm right, and if my memory serves me well, I can't say that I remember every single price that traded in 85 and 86. I don't think the 2-year note ever really fell below Fed funds rate. As the Fed was cutting rates, it would fall with the Fed. So, exactly what you've said, i.e. the 2-year note would not anticipate. But the other way, for example, 1987, when the Fed was hiking rates throughout until October of 1987, the 2-year note, if I'm not mistaken, and I'm taking a guess here, could have been trading something like 150 to 200 basis points over Fed funds. Always a far anticipating what the Fed would do in the future, far anticipating it. And that is probably what actually caused the October crash in 1987, because rates were very, I think I'm right in saying that although the Fed funds rate never got anywhere near double figures, the 2-year note actually got to double figures. So, because they were really, the bond market will fly higher or used to fly higher, because don't forget, this was a period after, this was the Volcker period, when there was no pissing around with 25 basis points. It was it was like, yeah, let's go, boys, one way or the other.
Right. Yeah, Volcker did not target the interest rate at all. He targeted the money supply, and then interest rate was a result of that.
Correct. So the moves were much larger than they are now by a factor of X. But I think that what is going to happen now is that the very short end is not going to wait for the Fed. Why? Because the Fed has already told you that they want to cut. And you saw this during the period from November, when they pivoted in inverted commas. We anticipated at the very short end, 6, 7 cuts? And I think that kind of market action is going to continue. Because when the Fed tells you that they want to cut and their bar to hiking is extremely high, then all you're looking is for the data that the Fed is going to use to justify doing what it is that they want to do. Therefore, now the market is going to anticipate the Fed at the short end and not follow the Fed.
That's that left side of the boat. So, Nick, we're talking a lot about steepening. Needless to say, relative to the long end of the yield curve, you were bullish on the short end. That's what a steepening means. What about the short end just in general? Like, if I were to ask you, do you like the 2-year on an unlevered basis? What would you say? If I were to ask you, do you like the 2-year on a levered basis, i.e. borrowing at 5.3 to buy at wherever the 2-year is, 4.8 or whatever?
I can tell you that actually I'm pretty neutral at 484. Why? Because we're already building in 1 3/4 cuts, right?
For this year, right?
Yeah, over the course, you can work out where the 2-year should be trading according to what you think the Fed funds level is going to be over time, and you can work it out that way. But what I will tell you is that at 510, I would be long of it levered. I don't care. Why? Because I think the odds of it going up from there are extremely bad, low, and therefore I would be long of it levered. At 580, at 484, I'm neutral, because unless I get a piece of data which suggests that yes, the Fed now is getting more of the confidence that it needs to start the cutting cycle, I can only be neutral about it. The market got itself spanked in January and since, and I don't think it's going to go to those extremes again without supporting data. And as I said, a series of supporting data, not just one data point, but several data points which all point in the same direction. So here you have to be neutral and you have to be basically trading it. But at 510, I would have no hesitation in being levered long, because the odds would be extremely good. It's as simple as that, I think.
At 510 on the 2-year, would you like selling puts on the 2-year or selling puts on SOFR futures, basically betting at a specific level that the Fed's not going to hike? No, you wouldn't.
Yeah, I would. I would bet that the Fed's not going to hike, but I would be levered long, because I think the odds of it going back towards 485 are much better than the odds of it going to 520. So if I'm risking 10 basis points to make 35, 40 basis points, I would much rather be levered long than be short puts, which are going to make me what? 6, 7, 8 basis points, whatever it is. Well, depends how far out you go, but I'd be much rather be levered long of the 2-year.
Can you speak as a trader about the various times where you think it is appropriate to express a directional view just by buying the asset, i.e., I own stocks or I'm long S&P futures, versus you actually take a convex position by going long options or short options. Although on this show we do not recommend going short options.
Why not?
No GameStop straddles to sell.
Yeah.
That's a bad idea.
Yeah, sell the 50 GameStop straddle at 100. Yeah, I find that kind of question difficult to answer because it's just too general. I just can't generalize like that. I think every market year has its own peculiarities, just like this one does. This has been one of the hardest environments in bonds for me for the past, 20 years or so. And simply because the moves are very small, and they also tend, in terms of yield, they're quite small. Basically let's have a look. What have the 30s been trading? The 30s since beginning of 24 have basically been in a 50, call it 60 basis point range. A 60 basis point range in my day used to be like a week's trading range. But here we've been best part of 5 months in a 60 basis point range. And also they haven't really been all that logical. So, and the markets, the bond market goes through these periods where it does things which are not hugely logical. And then all of a sudden it actually decides which way it wants to go and just trends. So I'm really waiting for that. My positions are very light, and I'm waiting for data to tell me which way this market really wants to go. Because if we keep on getting strong data like we've been getting, I think that by the end of the year, yields have long end yields, long duration has to be probably significantly higher than it is now.
Can you explain what you mean when you say the moves aren't as big? Because it's my understanding that, relative to my adult lifetime of post the great financial crisis, bond volatility is much higher now. And yes, you're not seeing maybe a 60 yield move, but a 60 yield move when interest rates are at 3%, as you know, is much bigger than when interest rates are at, yields are at 9%.
Basis points are basis points. But if you have a look at where the 30-year has been really 4.5%, what do you want to do for the past, since November? It's been lower, it's been very slightly higher, but this has been the equilibrium price. So the market is priced in an unrealistic level and speed of cuts from the Fed. It got told by data and by the Fed that it's not going to happen. It has repriced and basically has remained there for the past 2 or 3 months. Now, is that stability? It's stability for now. But I think that when if I'm correct that the disinversion happens, the moves at the short end are going to be so large. They're going to be like 150, 200 basis points. And that is going to be something like 40%, right? In terms of yield movement. So what I'm trying to say is that volatility for the past several months has been actually relatively low. And if you look at the move index, it's basically stuck at 100, which is the low end of the range since 2022. If you look at where I know they didn't work it out, but the move index back in the 80s and 90s would have been much higher than it is now. So It's only in the since the great financial crisis and until the tightening in 2022 that the move index was substantially lower than it is now. To me, that is a period of monetary repression. It's a period where the Fed was basically setting the interest rate and not allowing long-term yields to find their own market level. That period hopefully is over, not to be repeated in the near future, I hope. And now the market has found a level that it's comfortable at for the time being until the economic story changes.
When you say earlier that the bond market doesn't make a whole lot of sense, the moves don't make a whole lot of sense, I should say. Might an example of that be today when the PPI, producer price index, what was expected was 0.2% or 0.3%, and what the realized one was 50 basis points, so 0.5%. And okay, a hot inflation print, bond yield should go up, right? But bond yields actually fell. Would that be an example of the moves don't make sense?
Yeah, I mean, today you did have mitigating factors like the revisions and also the fact that you've got the really important data tomorrow. So I can understand it, but you've had European rates just keep on going higher when we all know that the ECB would like to cut rates in June. And if I were a betting man, I would put some money on them cutting in June, while I think the odds of the Fed cutting in June have to be worse than the odds of the ECB cutting. Also, the supply is in the US rather than in Europe, and yet, bonds have done nothing. So yes, it is one of the examples that the moves in bonds in US Treasuries have tended to make far less sense to me for over the course of the past 3 weeks or even 3 months than they used to. So it's a funny period. Something is going on. I can't tell you what it is. The moves are restricted and also illogical in a way.
We spent over an hour talking about bonds now. It's fascinating. I got to ask you about stocks. At the beginning, you said you were bullish on stocks over bonds. Why are you bullish stocks? In other words, just because you're bearish on bonds doesn't mean you have to be bullish on stocks.
No.
What motivates that bullish view?
Well, it's a relatively bullish view. I own no bonds, and for the first time in 20, 30 years, I find the yields unattractive. And therefore, if I find the yields in bonds unattractive, you have to invest somewhere. I always try to think how real money allocators think. And I would have guessed that they are thinking the same way as me. The balance sheet of the United States in general, i.e. of the United States Treasury, let's say, is in nowhere as good a shape as the balance sheet of AAA, AA corporates, in which case, why would I? And the economic data that we've been getting is very strong. The economy is continuing at a very good clip. Most of the increase in earnings quarter by quarter have been met. So everything that the market was anticipating more or less came to be true. And we all know about the famous fish hook that you start with expectations out there and you end up down here. But it has been by no means a disaster like it used to be. In fact, earnings are very good. Pricing power is good. The companies are passing on all the price increases that they get at the PPI level onto the CPI level, let's call it that way. So the consumers are having to pay the higher prices. The profit margins are remaining constant to improving. If that is the case, I can't see a case for bonds over equities, because one has a bad and deteriorating balance sheet while the other has a good and improving balance sheet. If that is the case, I can't see why you would. Of course, everything has a ceiling. Nothing grows to the sky, but for the time being, while the data that we are obtaining is the data that we are getting, and it's not changing, and it's not suggesting that the opposite investment strategy could be profitable, I'm just not willing to pick a top. I might get out of equities altogether and just be in cash. So don't get me wrong, there is a very strong argument to be made that the best investment at the moment is cash. A very good argument indeed. Now, the only question is, if you put money in equities now, are you going to beat the 5.3 in hurdle in cash? It's a 50-50. It's by no means an assured outcome. So, and I'm talking indices, of course, stock indices. My allocation, I am long of equities. I have no bonds. I have some tips, simply because a 2% real yield with a 3% sticky inflation rate, CPI, yields you around 5%, either via a coupon payment, but it won't be via the coupon, but via the nominal increase in the value of your bond. So, and that is much more than you can get on a 10-year note on a fixed income. So until the data changes, I think tips are preferable to nominal bonds. I think that equities are preferable to nominal bonds. I'm not sure how much either is preferable to cash. I just don't know how long this hiatus, this 5.3% will last. But I do think that there is a big reinvestment risk, because when it happens, it's going to be fast, i.e. when the data changes, it's going to change fast. And therefore, I have to have some money in tips. I have to have some money in cash, but I also have to be prepared to very quickly flip out of equities when that happens. It's just that I'm not seeing that happening at the moment. And until I see it, I'm prepared to give equities the benefit of the doubt.
Got it. So you like stocks over bonds, but when it comes to stocks over cash, you're not so sure. We said when the economic data turned, what data do you think is the most important? The unemployment rate is now at 3.9%, very low, less low from the beginning of last year when it was 3.4%. And we're adding, let's say around 200,000 jobs a month, and maybe a little bit more on that on average. At what level of either of those data points will you say, wow, the data is turning?
Well, I mean, I think Chairman Powell actually told us his level. His level is above 4.1.
In a press conference or in the minutes?
During his presser, if you go and listen to the last presser, he said, well, if the employment rate goes up, but I'm not talking about a 0.1, 0.2, I'm talking more than that. So more than that is 4.2. So, we can take it literally. You don't have to take it literally, of course. But that sort of unemployment rate would give him the excuse to cut. And again, he is looking for excuses, I believe. That is when actually the bond vigilantes could start coming in and really steepening the curve. Because they say, you're going to cut? Well, we've got other ideas. But, that would only happen if inflation stayed sticky, or we had even a surprise reacceleration in inflation and still the Fed cut. So, come up with that kind of scenario. Say you get this 4.2, 4.3 unemployment, and all of a sudden the Fed cuts because it's looking for excuses. It cuts 25 basis points, and the next CPI print, for whatever reason, is high. Well, what happens then? Then you really get a steepening of the yield curve.
Nick, it's been great getting your in-depth thoughts on bonds. I kind of almost want to apologize for even asking this question, but it is on people's minds. I mean, front page of Bloomberg, GameStop is surging again. It went from about $30 to $70 in the pre-market, but now it's at $50. So as we record this in the 12:20 of Tuesday, May 14th, it's up 65% from the close of May 13th. Super general question. What are your thoughts? What comes to mind?
What comes to mind is the conclusion that monetary conditions are probably not tight enough if this kind of thing can happen. But I think the high level point that I'd like to make is that the algos have probably been rewritten for this scenario. I think that people anticipated, market makers rather, let's call them Citadel or whoever, or Ken himself, anticipated that at some stage this would happen again, because there's always an again, isn't there? It's happening again. And therefore, they've rewritten the algos to fight the moves far later and probably even help the move initially to get people trapped at much higher levels. Now, we all know that at some stage, or we all should know that at some stage, GameStop is going to come out with a rights issue, and the supply will be there. And if that supply is not enough, they'll issue more and more and more until it is enough. So it's only a question of where the top is. It's not a question of if we're going to get the top.
Trees don't grow to the sky.
So trees don't go to the sky. And certainly if I was the managing director or CEO or whatever of GameStop, I'd be on the phone to my investment bank and saying, how quickly can we put together an offering? And, how large can it be? And, can we have one in reserve just in case they absorb this one? And posing all sorts of questions like that, because these are unprofitable companies that are burning cash, and therefore they need more and more funding. And equity funding is free. So, they're not going to issue bonds. They're going to issue equity.
So you think it will end with a steep decline, but it could, anything could happen. It could go up more.
Is there a natural ceiling to a price, an equity price? No, it can trade at 200 tomorrow. It's impossible to tell how far, demand can push it and how thin it is. I mean, it's trading 120 million shares today. I mean, that's, and we are at what, midday? It's still halfway through the day. So it could be trading $250 million shares by the end of the day. The incredible volumes, especially for a stock that's trading at 50. I mean, that he was trading far less than that when he was trading at 15, right? I mean, in terms of volume. So it's incredible that these things are still happening. And to me, they're yet another indication that policy is just not tight, even if Powell says it is, and that at some stage, the bond vigilantes have to make a comeback. I'm sure that it's not anytime soon, but if things don't change and the economic numbers don't turn the way I've described, at some stage, duration gets sold, and sold hard. And that's the time that you have to be worried about equities.
Because the bond market will take
the multiplier effect. Yeah. It's the equities will go down far less than bonds in percentage terms, but they'll still go down.
Nick, thanks for coming on and sharing your views. Tell us quickly about the Two Gray Beards, which you host with fellow Forward Guidance guest Andy Constan, as well as charityhedgefund.com and riskdials.com.
Charityhedgefund.com is where I tell my subscribers, each and every day, how I'm thinking, what I'm thinking, the levels that I would like to trade, why those levels. I do a lot of option trading in the bond market. I do some option trading in indices and stuff like that. But I basically try to explain my train of thought and why I think certain levels will trade over the course of time. Two Grey Beards, as you said, is where we run a real money account and we reallocate money from equities to bonds, to precious metals, all assets basically apart from crypto. The only reason why we don't do crypto is because we are old, we're two grey beards, and we know nothing at all about crypto. And we'd rather not have money in something that we don't think we have an edge. Nothing against crypto, we just don't know enough to recommend an investment in it. But it's what we used to call in the UK a widows and orphans type of fund, i.e. we are not leveraged, we are very conservative. It's basically for people like us who are in their old age and would like their money to appreciate at something like 7, 8, 9, 10% per year without much volatility. In fact, with as little volatility as possible, and certainly far less volatility than if you were in a 60-40 allocation equities against bonds.
Or GameStop.
Or GameStop, yes. So we're not trying, it's not a hedge fund. We're not trying to make a lot of money. We're trying to make a reasonable return that a person can live off comfortably if you have $1, $2, $3 million invested that you'd like to invest in the market, and basically swap it around when, invest in equities when the risk reward is good, get out of it when it's not so good, and maybe be overweight in cash. Everything that we've been discussing, we've been discussing, is it better to be long of equities or be long of cash at 535? Well, we agreed it's not so easy. It's not such an easy decision at this level. So what we've done, we've moved out of equities, we've bought calls because volatility is very low, and we've put the money into, a floating rate note, which gives you 535 and also has the potential to get you higher yields should the Fed ever decide that current monetary policy is actually not restrictive. So we do these rebalancings of the portfolio, trying to make a little bit extra than you would if you were in cash. It's just basically as simple as that. As I said, a widows and orphans kind of approach.
Did you talk about wristdials.com?
Wristdials is where I publish my videos. I do a video every week about what I am expecting for next week and for all the various asset classes, the levels I'd like to trade and why, again. While in Charity Hedge Fund, where they get those videos as well, I actually tweet each and every day and say, yeah, do it now, do this, do that, I've changed my mind, etc., etc. So that's a much more active hedge fund type trading style, while the video, the risk dials gives you a whole bunch of models and indicators and gives you allocation models which change over time, and also the videos that I do every Sunday.
I look forward to checking that out. Nick, thanks again for coming on, sharing your views, and thanks everyone for watching.
Thank you, Jack.
Thanks for watching. Remember to check out vaneck.com/HODLFG to learn more about the VanEck Bitcoin Trust, ticker HODL.